Good day, wizards, and welcome back to Economics Grade 12. We've previously had a look at your section based on protectionism, free trade, import substitution, and export promotion. Now we're going to take a look at the dynamics of markets, specifically pertaining to perfect markets. So this is your second topic, which is part of your CAP syllabus curriculum. But first, just like previously, we're going to have a look at some terms and some definitions that you'd need to know. So firstly, what is a market? A market is a specific place where buyers and sellers meet in order to trade either goods or services, depending on exactly what they're trading. What is a monopoly? A monopoly is a business that has complete control over an entire type of market. Then we have a new term for you, oligopoly. This is a type of market structure that's controlled by an entire group of businesses, not just one. Next, we have perfect competition. So, perfect competition is a market structure with a larger number of buyers and sellers. So, we've got a market where buyers and sellers meet, and then you have perfect competition, which is the market structure with a large number of those buyers and sellers. You then have monopolistic competition. This is a market with competition, however, the products may vary. So even if somebody has a different product than the other, they can still compete with prices and businesses. Your next term would be economic loss. So economic loss is when your total cost is more than your total revenue. So remember, we have a profit and a loss. A loss is where your expenses exceed your income. So in this case, because we're dealing with economics, it's where your cost is more than your revenue. Next is your profit, your economic profit. Your economic profit is where your revenue is greater than all of your average costs. You then have price taker. So price taker means having no influence on the price, thus accepting the price as it is. So let's say, for example, you want to actually argue a price or come to a better price with the person that you're buying from, or somebody is trying to bargain with you because you're selling them a good or service. Price taker means that you don't have any influence on the price. Nothing is going to change. You accept the price as it is. You then have a normal profit versus the economic profit. A normal profit is where your minimum earnings is there to maintain an entrepreneur's business. It's basically just after break-even point, you have a normal profit, an average minimum earnings. You then have long run and short run. These are more definitions that you need to know. So long run is the production period where factors can change. And a short run is the production period where only the variable factors can change. Your fixed factors or your fixed costs won't change. In your short run, only variable factors may change. So let's look at perfect competition. Perfect competition occurs in a market structure with a large number of participants who have access to all required information about the marketplace. All of them are price takers. Prices are determined by demand and supply. Examples of market structures that demonstrate perfect competition or the best conditions of a perfect competition include your stock exchange, your foreign exchange market, the central grain exchange, and agricultural produce markets. A perfect market is a market where no single buyer or seller has a noticeable influence on a specific price of a good. This gives a true reflection of the scarcity value of goods and services. So now we're going to go through some characteristics or conditions of a perfect market. Products must be homogeneous, meaning identical, so that they can compete solely on the basis of price, and they can be purchased anywhere. There should be a large number of both buyers and sellers, and it shouldn't be possible for one buyer or for one seller to influence the price of that product. So when there are many sellers, the share of each seller in the market is so small that the seller can't influence the price. Sellers are the price takers. They accept the prevailing market price. If they increase prices above the market price, then they'll lose out on customers. So there should be zero preferential treatment or discrimination against buyers or with regards to the goods that are being sold. Collusion occurs when buyers and sellers make an agreement to limit competition. In a perfect market, no collusion takes place. Both buyers and sellers base their actions solely on the price of goods. So homogeneous products or similar products fetch the same price, and therefore no preference is shown for buying or selling to any particular person. So for buying or from selling to anybody. Free competition then exists, and buyers must be free to buy whatever they want to in any firm and in any quantity. Sellers must be free to sell what they want to sell how much of what they want to sell, and to sell exactly where they wish to sell. There should be no state interference and no price control. Buyers shouldn't form any groups to obtain lower prices, nor should sellers combine in order to enforce higher prices, because they'll lose out more clients like that. Efficient transport and communication ensures that products are made available everywhere. In this way, it changes the demand and supply in one part of the market, and those changes in the demand and supply of the market will then influence the price in the entire market itself. Efficient communication keeps buyers and sellers informed about market conditions, and all participants must have perfect knowledge of market conditions. All buyers and sellers must be fully aware of what's happening in any part of the market. Technology has increased competition as information is easily obtained via the internet now. So there's free access both to and from markets, meaning producers can enter and leave a market without any interference whatsoever. Now that we've gone digital, it makes it easier for them to access it via the internet or a web-based platform. So entering and leaving a perfect market is as easy as less capital being required, and therefore there are fewer legal restrictions. So the factors of production are completely mobile. They should be able to move freely in between markets, and in reality there are very few perfect markets. However, there are some sectors, like for example mining, let's say gold mining, and then agriculture, maize agriculture, where many of these conditions are met. These sectors illustrate the way in which the market mechanism actually works. The individual business and the industry. So how do we determine the market price? In order for us to determine the market price for a firm under perfect competition, you need to draw two graphs next to each other. On the left is a graph for the industry, and on the right is a graph for the firm, which is the individual producer. The graph for the industry is a demand and supply graph. Combined, thus looks like an X shape. The graph for the individual producer is a straight horizontal line. In the graph for the industry is an equilibrium at the point where both of the graphs intersect. These points determine the market price, as both demand and supply are at that point equal. So you have a line for your demand, a line for your supply. Where they intersect in between is what the market price will remain at. The individual producer graph can't influence the price alone and is compelled to accept the market price. So let's look at a demand curve for an individual producer. The individual producer is a price taker and sells goods at the market price. At this price, the demand remains constant. A higher price can't be charged, as customers will be lost to other producers in the market, and thus the price remains unchanged, it remains the same. So we've got a graph in front of you with your x-axis and your y-axis. Remember, your x-axis is your horizontal axis and your y-axis is your vertical axis. Your x-axis is the quantity that's being produced and sold, and your y-axis is the price at which your goods are sold. So like we've said, specifically in this market or demand curve for an individual producer, they're a price taker and they sell goods at the market price, so the price remains constant. As you can see in this graph, your market price is one straight horizontal line. Next, we look at profit maximization. So there are two ways of profit maximization. There's a graph in front of you where you've got your x-axis as quantity and your y-axis as price, which is your marginal cost. So with this graph of profit maximization, as you can see, it's going diagonally up. Reason being is it's at different prices for different quantities. So in the graph above, from the point 8 and 40 and above, the firm shall be adding to the profit. All points below indicates that the firms are losing profit. So at point 8 and at point 40, the firm maximizes their profit. This is where MC is equal to MR, which means your marginal cost is equal to your market price. So in the next graph, we have TC is equal or is greater than TR, meaning the business makes a loss. This means your total costs are greater than your total revenue. Remember previously we said, for example, if your costs and your revenue are equal, it's you being at break-even point. When your revenue is more than your costs, it'll be a profit, like in the previous graph that we looked at. In this graph, your total costs are more than your total revenue, and therefore the business is running at a loss. So if your total revenue is more than your total costs, if your TR is more than your TC or greater than your TC, it makes a profit. Once the maximum profit is then achieved, profits start to decrease with the next unit of output. As you can see, you have your unit of output in this graph as well.
We need to learn to live with the COVID virus, the new normal, at least for the next few months. And we have just what you need to make sure you never miss a single school lesson. And it's absolutely free, mahala! High quality, powerful, animated lessons for all your subjects. So don't spend a cent until you have tried iWhiz. It's everything you need. All video lessons, textbooks, workbooks, exam prep. We want you to ace 2021.